now we pivot to Asia, and I just wanted to address, so I got a great question in the comment section, and I unfortunately I didn't have a chance to answer it directly in the comment section. I will, but the comment was, isn't China doing the right thing in terms of cutting, trying to drain this liquidity, not being overly stimulus heavy, and trying to, again, adjust some things? Because when you look at and you use the example of, this individual talking about, well, what happens, when you look at the U.S. and all the stimulus and NFTs and crypto, it's like, well, yeah, like you're seeing a lot of excess in the U.S. and China is doing the right thing. Like they are trying to take that liquidity out. The question comes down to, is it too late? And in the end, at the end of the day, the question is it going to be a hard landing or a soft landing? So you're going to have a recession, you're going to have a slowdown. It's just, are they going to fall from such a level that it's still going to be a hard landing no matter what they do, but they're going to try to do everything in their power to soften it? The other question comes down to, do they have the willpower to allow the slowdown that they need? Because right now, if you remember, their trajectory is at least 6.5% GDP growth. Are they willing to accept 3% or negative 1%? Are they willing to accept something? Because every time they get to this pain point, when we look at 2019, when we look at 2017, every time they get to this pain point, they panic. And they instantly reverse everything that they've done. And so far, they haven't panicked. They've actually allowed things to go bankrupt. They've allowed defaults to happen. So you could say it is different this time, and they are trying to clean stuff up. But again, that's also going to point to an additional slowdown and additional pressure points as we go through the year. But the U.S. also stimulating is also a stimulus for China, because all of this flows down. A lot of this is again, these movements down. But when you look at like just a headline I came across, so Atlanta Fed GDP now index falls to 3.66% from 5.3%. So when you look at the U.S. continues to slow, and we're the biggest buyers from China. So, and then you look at other nations, as we'll talk about in Asia, also slowing. So China really has no choice at the same time, because their end markets are also contracting. So they're just trying to manage this the best they can to, again, take some of this froth out, allow the things to get back to some sort of normalcy, because right now they are well ahead of where the U.S. is in playing with funny money. It's just the U.S. is a bigger nation on just a gross GDP number, not a percentage, but an actual figure. So our numbers are bigger, but on a percentage level, China dwarfs much of the world in general. So that's why there's a lot of wood to chop. And will they have enough willpower to stay the course over that longer term period to drain that excess? And that's, I think, a great question. And that's something that we're going to have to look at over this time period, because I actually don't think they panic. I think that they've set themselves up with, we can blame COVID, we can blame supply chains, we can blame shutting down ports, whether or not that was political, whether or not that was so that they have an out. They've set themselves up where they can miss that 6.5% number. And I think the market is starting to expect that, which is why I said when they put out that number and all of a sudden the market was like, oh, it's going to be 8.7%. I'm like, what numbers are you guys looking at? Like, we look at, and again, we all look at the same data. So you're going to have bears, you're going to have bulls, obviously been a lot of bulls, but that's what makes a market. So you're seeing the same data, but to say that you're going to get this 9% growth, where? And that's where I think you're starting to get some of this normalcy coming back through, and that's bringing expectations down. And actually, I think you'll start to see them printing below even their target, just because they're seeing some of these pressure points. So that's just a quick answer to, I think, a great question. So now when we start turning to the Chinese data, again, speaking of slowing, industrial profits year over year, last month was 20%, down to 16.4%. Non-manufacturing PMI was expected at 52, came in at 47.5. Manufacturing PMI was expected at 50.2, came in at 50.1. Composite PMI coming in at a contractionary level of 48.9, and the Caixin China PMI manufacturing expected at 50.1, coming at 49.2. So this is the culmination of what we've been talking about. We talked about it in June, again in July, and then excessively in August, because then you had natural economic slowdown. Then you had COVID dumped on top of it in August. So we saw these big contractionary numbers, especially on the non-manufacturing or really the consumer. We'll see a bump. So, as someone who, I don't know, has been called a perma bear, is told I'm bearish, I look at data. This will get better. So you will see the pop, because COVID was that overarching thing. On a political level, they have a zero tolerance for COVID, where they'll just be quick to shut everything down. So again, that's going to lock down your consumer. You do have Singles Day coming up. That's a huge number. That's a huge increase in spending. So realistically, that services number, I have no idea why I was at 52. You just have to look at what happened and know that it was going to be at least something close to 50. So I would ignore the survey, but when you look at where things are, I think that it will adjust back up. And I think it'll be above 50. I don't think we're going to see this huge expansionary number, but it'll be something where manufacturing I'm more concerned on, because that didn't see the COVID impacts. Manufacturing, they are an exporting nation. Local consumption has been terrible. So manufacturing, again, is going to be that overhang. And the fact that the Caixin came in contractionary level, I think that is what we're starting to see, which is why we talked so much about last week, and I should say the last couple weeks, the focus on finding ways to stimulate the smaller companies, because that's where the biggest struggle is. And we'll talk about that way more throughout this segment. So on Wednesday, the State Council had its regular get-together, and what was the number one thing? Help small firms. The big news is that the State Council has instructed the central bank to increase re-lending to banks by an additional 300 billion renminbi this year. So I wouldn't call this a panic spend. I think this is more of a targeted move that it won't create a huge, again, when we look at credit impulses, the goal is to keep credit impulses at this fixed level, and they've let some liquidity expire. So they've already pulled some liquidity out of the market, allowing it to be more targeted at this end. So again, something to manage. Relending occurs when the central bank provides a commercial bank with funding for an existing loan. The loan typically needs to be to a small or agricultural firm to qualify. Again, small businesses. But the State Council also flagged a bunch of other measures, establishing a national guarantee fund that will back guaranteed institutions to facilitate borrowing by small firms that lack collateral and credit records. That's a concern, because how much bad debt are you going to start to source? Are you incentivizing poor lending standards? And that's when you look at off-balance sheet, what we saw with this off-balance sheet risk now getting put back on the sheets. Are they just coming out and now guaranteeing that, or providing some sort of support behind it? Reduce lending rates for companies adversely affected by the pandemic, increase support for entrepreneurs and innovation, help small firms get their outstanding trade receivables paid, encourage local governments to alleviate pressure on rising costs on small firms. The State Council said the measures were necessary to stabilize growth and ensure employment, because employment has gotten worse. Relending has become Beijing's go-to tool for increasing the flow of credit to small firms. In August, the PBOC increased the facility by 200 billion renminbi. But again, only a handful of provinces have gotten it, and I think they're looking to expand. And that's when you start looking at China's private sector still hasn't recovered from the pandemic. And this is where you can see it. So when you look at the backdrop, so medium firms have gotten a little bit of a love. They're at 51.2, but small firms are stuck at this contractionary level of 48.2, with large corporations also seeing this move down to 50.3. What I think is going to happen is you're going to continue to see large corporations weaken a bit more, come closer to 50, medium corps kind of flatline at this level, and the goal is to bump these small corps up to at least 50. I think there's enough issues in the global market, in the local Chinese consumption market to really, I think there's going to be a struggle to realize a lot of these gains. And I think even though they're trying everything that they can within a very controlled means isn't going to be enough to get this back up, because there's a lot of other specific headwinds that remain against the growth at that smaller level. So with the COVID outbreak, now largely under control, expectations are the above 50, but a just over 50 print again is it's expansion, but it's barely expansion, which is why, like, we always say that when you're between 50 and then 51 and 49, you're kind of in like this margin of error. But when you start getting to 48, 48.2 right here, that's when you're really starting to see some contraction accelerate at a bigger level. And it's coming as well, because when you look at new export orders are falling and are contracting, new orders in general, so that's local and abroad on the non-manufacturing side, have just imploded. So the contraction is, so like, this is why Caxton and the PMI and the manufacturing PMI, it looked okay. It was slightly expansionary or slightly contractionary, but the internals are really weak. And that's when we start to say that there's going to be some offset, as you start to see some things pick back up in September, but we're not going to see this big bump up because, again, the internals are showing some pressure points as China's Caxton manufacturing PMI slipped into contraction for the first time since May 2020. The sub-indexes for production, demand, exports, and employment all slipped into contraction, while the sub-indexes for material prices and product prices increased. So all the good things came down and all the bad things went up. Again, this is that employment going down, and then when you look at material prices, product prices, what is that? Inflation. Inflation goes up and is going up. Employment coming down, new orders coming down. Again, you see how this is kind of layering in to a much bigger problem. So then when you look at construction starts are falling, activity is slowing. Housing sales growth has slowed, especially dramatically in the recent months. This is where we continue to see this contraction. And this is a mixture, coming back to the original question from, that great question. It comes down to, this is what they're trying to put. They've used this as a crutch to really boost the economy. And now they're essentially saying, look, we can't use this as a crutch anymore. It's priced people out of homes. We want homes to be affordable. So this is going to continue to contract while China release metals from state reserves September 1st. China released 30,000 tons of copper, sell 50,000 tons of zinc, and 70,000 tons of aluminum from state reserves. Again, trying to manage that inflation. And remember, construction takes up a lot of these things, and we're not seeing a whole lot of construction, but yet we're still seeing these huge price increases. 6 administrative agencies issued a notice calling on financial institutions to better support offline businesses, not just from raw materials, but the issuing agencies are coming from everyone. PBOC, Minister of Commerce, Ministry of Finance. Specifically, they want to directly help offline retail, accommodations, catering, and foreign trade. Because if you look at foreign trade, the PPI has exploded. Export prices have exploded. Then they're trying to protect local pricing, but you're still seeing that get passed on to the international market. And there's a huge problem because now you're starting to see them pivot into other countries, trying to find other ways away from some of these entities. So then when we look at that trade gap, so when we look at some of the risks that sit, so the Caxton market manufacturing PMI, which is advanced 3 months, when you look at, take that to go all the way through, is just showing that the U.S. is going to continue to slow. It's not going to slow at the same pace, but it's just going to be kind of an anchor pulling things down and acting as that overhang. So then Xi offered China's tech giants some friendly advice because remember, they've been attacking tech. So when you're cutting some, which are, again, some of your largest companies, and when you look at the common prosperity, dual circulation strategy. They're really coming after the largest companies because they have the most profit to give, which is why I keep talking about large companies coming under pressure. So Xi offered some advice. We should promote common prosperity from a strategic perspective and create space for small and medium-sized enterprises. We should guide companies to obey the party leadership and serve the big picture of social and economic development. Obey the party, be a good communist, but you need to make sure to make room for the smaller guys because that's where they've recognized. I mean, just look at the U.S. You need small business. And without small business, you're gonna struggle. And that's, again, another key piece of the dual circulation strategy. Local consumption, local commerce, local buying, local spending. This is, again, the small and medium companies are gonna be the ones more levered to that. And at the same time, local employment. Again, these are some of those key pieces. So when we look at details about how the government will proceed, again, remains scarce, but China's big tech firms in Beijing remain in those crosshairs, continue to be the focus point. Tennyson announced it would invest 50 billion renminbi to promote common prosperity. This will include investment in rural revitalization, healthcare service system improvement, and more equal education services. Again, healthcare, education, homes. Tech is like, look, I know I need to be a good party member, so you stay away from me and don't attack in different ways. Again, coming back to Alibaba. So let's just get ahead of this. On August 31st, private car maker Geely announced it would grant 350 million new shares to employees, representing a 3.5% stake in the company. Again, trying to push down to the smaller guy. Chinese business owners know the party is serious and they're looking to adjust and try to show that they're on board. And then soon foreign companies will be forced to appeal as well, increasing cost. So that's why when we look at, like last week, we talked about China versus Vietnam versus South Korea versus Japan. The cost of an employee in China continues to go up. So if you're a foreign entity, you have a lot of political pressure being in China, you're now seeing your costs go up. Do you need to be in China anymore? And the answer is yes. You do need, but do I need 5 facilities? Could I use 2 and start to branch out? And I think those are some of those bigger pieces that are moving across the board. So then when we look at the apparent change in demand, so as we keep talking about common prosperity, dual circulation strategy, well, apparent consumption or consumption in general, sharpest drop since 2015. This is when the CCP has panicked. When you see this, and so they're addressing it, but they haven't clearly said we're just going to give money. They're trying to do it in a more strategic way to avoid some of the pitfalls that we've seen and that they've done in previous years. Because remember, at the end of 2016, they opened the floodgates and they just pumped money in, which really paid dividends in 2018. But then you saw a steep drop in 2019 when they panicked again. And then obviously you have COVID. So it's just going to be a mixture of where are they going to manage, because this is what they want to change and they're failing. The dual circulation strategy, the common prosperity, it's great in name, but it's not coming to fruition, even though this has been a target since May of 2020. So we're over a year into it, and we continue to see pain across the board. And so China, like most countries, maintains substantial state reserves, which is what they're trying to manage. It includes coal, oil, fertilizer, foods, materials. This is why they're trying to manage inflation, especially internally, to drum up this consumption. So they also did other things. So the CCDR indicated that the reserve system needs an update. China must have a strong national reserve system and emergency response capabilities that match its status as a major power. Again, trying to manage, because they see trade fears, they see trade wars, they see an increased hostilities, struggles in general, so they need to have a certain amount of backup. Specifically, they want better planning and optimization of the materials stored, faster replenishment, improved purchasing of reserve materials, better allocation of reserve management, improved reserve management models and mechanisms, better reserve purchasing and rotation models. Again, all about market stability to offset international pressure and try to drum up some of this growth, some of the spending, which has been slow to materialize. So then when we look at China, the 3 heavy burdens on households, living costs, that again, why we keep talking about pricing, why we keep talking about local cost of goods, because living costs, housing, why they keep going after housing, trying to bring housing down, children's education. The three biggest things is why, again, this is why you have to look at what they're saying, what their new policies are targeting, because we know they're an issue, but we won't know how big of an issue until they want us to know. And here's where you're clear. I mean, not to say that we didn't know things were getting worse, but this is putting into perspective just how bad it is in some of these levels, especially living costs. That's the one where even though inflation looks low, because they've tried to manage it, they're still importing and they still have wage compression. So even though CPI hasn't gone up as much, especially as we've been showing the spread between CPI and PPI, it still doesn't mean that living costs haven't gone up because wages remain under pressure. So then when you look at all of these things, the biggest borrowers, so China's top 10 high-grade corporate borrowers of dollar debt by the obligation. So when we look at the yuan, you look at Tennyson, these are some of the concerns that we have, which is why we keep seeing some of the money pushed in. You're starting to see some of the money coming in to support some smaller entities, some potential off-balance sheet risk. But these are going to be some of the bigger ones to look at going forward as we see some of these pressure, especially after the issues with yuan. And when we look at all of the debt pressures, we look at all of the issues that they're trying to manage, we have to look at, again, the household saving rate has come down. So when you look at spending, savings rate has come down, even as spending has also come under pressure because wages have been tough to come by. As we keep talking about, the PBOC maintains ways of paying into local governments past the provisional bottlenecks because there's a lot of struggle at the local level, which is, again, pulling some of these additional savings out as living costs remain 70% of underlying household costs, and they keep coming up, getting pressure to the upside. So then when you look at those teacher turmoils, remember, they're coming after education. They're coming after the private side. You need those are jobs. So when you look at the education sector, here's where you can see some of the pressure, some of the protests that have started to crop up, and we expect this to get a bit worse. And then when you look at, all of these things are happening, and what's happening to the pool of workers in China? Well, in 2020, the number of migrant workers in China dropped for the first time in more than a decade. Why? Travel restrictions. But they also want more local jobs, more local consumption. So what's the easiest way to do that? Limit the amount of people coming into the country and increase the amount of local hires that you have across the board. And the other issue is more than half of China's migrant workers are 41 years and above. So this is when you're looking at local migrants. So when you're looking at going from the rural areas, the provinces, into the urban setting or into some of the farmlands, they are aging out. And this is going to become a bigger problem because a lot of the younger generation, which has gone to school, which, there's not as many as we keep talking about the aging population, the population issue, the conundrum that they're falling into. This is, I think, a perfect example of how that's going to impact things going forward. Because when you look at the pressure of the average age going from 30, when you look at ages in general going from 30 to 41, and you're seeing this pressure just in general, how do you offset that with one-child policies put them in a tough spot with, again, looking at worker availability and overall production? But now when we turn abroad, to the rest of Asia, and we look at the ASEAN, you can see that PMIs have flatlined. They haven't gone up, but they've stopped going down. So they still remain firmly in contraction territory at 44.5, but there's limited upside. And that's where we're gonna see upside. COVID we're on the other side of COVID when we're looking at Asia and Delta. So we're on the other side of it. I am not saying that we're not going to work our way back to 50, but it is going to be a slow grind because the local consumer, the local consumption is under pressure, especially when you look at the further rapid fall in output in new orders. New orders not coming in. Again, that's a leading indicator for softness. and the business confidence continues to weaken on the back of it. So then when you look at total exports by various Asian economies have gone up. Again, coming back to moving away from China, diversifying supply chains. So this is where when we talk about ASEAN PMI, even though new orders have fallen, there's still backlog, there's still exports to come. And this is going to be supportive of just that slow grind back to 50, still going to be contractionary, but still going to see an upward mobility on some of those data points, but again, still be a drag on the global economy. So then when we look at South Korea, so industrial production slightly above estimates was expected at 7.2%, came in at 7.9%. Leading index change slightly negative at negative 0.2%, but again, still within a margin of error. Exports year over year expected at 34%, came in at 34.9. Imports expected at 44.6, came in at 44. We expect that to be fairly stable, just given that their exports are still there. They've been the preferred spot to pull down from, but we also see China buying ahead of something. They've been increasing their trade with South Korea, so that's been a tailwind, which has been a positive. But the South Korean manufacturing PMI went from 53 to 51.2. So we're seeing this slowdown as a lot of that trade has been done. A lot of those exports have come through. We still see more, but not to this level. And that's, again, going to be some of that contractionary pressure as we go forward. And when we talk about Korean exports to China, the 20-day exports to China, you could see are through the roof going back to 2019, because China continues to try to build up storage, try to build up inventories, which they're relying significantly on South Korea for. But the household debt in South Korea continues to rise because, again, they had COVID. They had, there was a pressure on spending. Inflation is still an issue in different regards, not as much in South Korea as other places, but still there, requiring a bit more of that household debt. But also, why not take advantage of the fact that money is cheap? They did increase rates, but to 0.75%. So it's still a rate rising cycle. It's still an upward move. They're saying that, look, we don't need to keep stimulating the same way, but again, it's still very cheap, and you're seeing people take advantage. And this is that increase of 25 basis points. So you're seeing they're still near all-time lows, just slightly off all-time lows. So again, still an easing cycle. And then when we look at India Sales Manager Index, still in contractionary, we're still seeing pressure within India, as we were talking about with what diesel is telling us, what the export market is telling us, and that filters down into business confidence, slightly expansionary, market growth expectations flat, sales growth under pressure, prices change, starting to go back up, again, more of that inflationary pressure, but staffing levels still not there. And this is the underlying problem where when we look at staffing levels, it remains under pressure, and it's not just a U.S. issue. It's not just a European issue. It's an Asian issue as well, especially in India, and then we have obviously profit margins. So a lot of pressure on an economic level, which is being shown in diesel. Gasoline is better. So you're starting to see some of that market growth that's being supported by some of that gasoline side, some of the consumer, but as an underlying growth profile, that diesel is indicating a much bigger problem or a longer issue on getting that economy back into a growth mode based on just where that is the indications are. Now, when we look at that and then tie that together with where things are, so the Evercore ISA Company Survey Diffusion Index for China sales for August is showing is at negative 4.7% versus the China manufacturing PMI that we talked about being just above 50. Now, the problem with the Evercore, it's looking at the big companies. And this is where we continue to say that the big companies are going to continue to struggle. And that's going to kind of be that anchor that's going to keep the manufacturing or the PMI from really going back up. It's going to keep it flatlined because that smaller, the large entities are feeling that pinch and that pain, as we saw with new orders falling into contraction, new export orders going into contraction. So that's going to be the overhang. A lot of that materialized in August. It's still going to be an overhang in September, but some of the service side, you're going to see some of that pickup just as we get some of the adjustments following the some of the COVID, being on the other side. So then when we look at Vietnam, exports had a big miss. So the exports were expected at 6%, came in at 5.4%. Imports were expected at 25%, came in at 21.2%. So imports are still elevated. So you're still going to get a stronger export number, but they're both missing estimates as you get this compression and these additional problems driven by COVID and driven by that slowdown in exports, which is why we keep talking about the global market. Trade is starting to come to a halt just because there's so much backlog. They're just not issuing new exports. They're struggling to maintain what is currently there. And this is where we continue to see some of these back and forth with CPI coming in right around the expectations, expected 2.9, came at 2.82. But retail sales were expected at negative 3%, came in at negative 4.7%. Industrial production was expected at a positive 1.2, came in at negative 7.4%. This will get better in September, but not by much. And that's going to be, again, that overhang where Vietnam, remember, was that kind of growth spot. It still is. If I had an option, you'd buy some weakness in Vietnam because there is growth there, but there is COVID. There is that greater piece behind it in terms of the global economy, which is going to be a bit of that overhang, which is where you're seeing, again, retail sales missing. You're still strong in terms of historics against 2020 and 2019, but the pace is starting to cool off. Wages under pressure, inflation ticking up a bit. And then again, the industrial slowdown, is my job safe? Is it not safe? Should I be saving? And these are some of those things coming into play. And now rounding out with Japan, when we look at Japan, retail sales slightly better, expected 2.1%, came at 2.4. Month over month was a big driver, expected at 0.4, came in at 1.1. When we look at industrial production, was expected negative 2.5, came in at negative 1.5. So again, you're starting to see a little bit of benefit, things are starting to pick up a bit in Japan versus some of the other problems that we've seen with manufacturing. PMI expected at 52.4, last month was at 52.4, came in at 52.7. So still expansionary, not crazy growth, but again, still moving and bumping along as they continue to come out of the other side of COVID. So again, these are some of the benefits that we're seeing, some of the pressures in China, we love the back and forth. We love the questions. I know we covered a lot of information, but we hope you have a great Labor Day for those in the U.S., a great long weekend. So thanks again for watching. If you have any questions, please let us know. You can find me on Twitter, comment section, email. Always happy for the back and forth. So if you don't, we'll have our Frac Spread show tomorrow, so you'll see my smiling face one more time. Hopefully I'll have a chance to shave by then. But, so again, thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.